This episode of AHLA Speaking of Health Law is brought to you by AHLA members and donors like you. For more information, visit AmericanHealthLaw.org.
Good afternoon, everybody. My name is Michael Kuczynski. I'm a vice chair with AHLA's Tax and Finance Practice Group and a counsel with Polsinelli Law Firm's Not-for-Profit Organizations Group. Today, we're going to be talking with Vince Tennerelli, who I'll let introduce himself in just a minute, on his really wonderful article, Protecting the Tax Exemption Privilege, Guidance on Taxes, Audits, and More for Not-for-Profit Hospitals, which was recently published in Health Law Connections. I had a great time reading this article, and it really spoke to me given my backgrounds, having worked at EY, practiced in-house as an executive director of tax at a large not-for-profit health system, and now practicing in private practice at a law firm. So with that said, I'll let Vince introduce himself.
Hi, I'm Vince Tennerelli. I'm Associate General Counsel at Community Health System in Fresno, California. Before coming to Community, I was an Assistant U.S. Attorney in the Eastern District of California for about 7 years, started in the Civil Division, doing False Claims Act work, and then moved to the Criminal Division where I was doing more white-collar work. And since moving to the health system, I focus on physician contracting, regulatory compliance, and I was sort of the person designated to dive into our 990s, which was my first foray into tax since taking it in law school in 2008. So yeah.
Wonderful. Thank you for that background, Vince. It's a really appropriately timed article. As we spoke about last week when we were just going through the article, the 990, it's a publicly available document. And that means that watchdog groups, the local newspapers, the IRS, state agencies, activist groups, they're all looking at this document. And the parts of it that you focused on in your article are Schedule H and Schedule L, which of course are two of the more high profile and I would say high risk sections. So my first question to you is, having not touched tax since 2008, how did it land on your desk?
I think because somebody had to be had to be assigned to it, and I was the new guy in town, and I think we wanted to have a little more legal involvement in our 990 filings. I know that with a lot of health systems, this was really a function that has been delegated to assigned to finance for a long time and to the outside auditors, but we wanted to make sure that we were very comfortable with the material in it. And so I was sort of assigned to this project and dove into the instructions and, kind of went from there.
Yeah, I think getting legal involved in the 990 and the disclosures, and especially the sections that you've highlighted, it's really smart. I think it's something that I've always struggled with a little bit, especially when I was in-house, is what's that balancing act? I'm curious, in your experiences now, have there been any practices or takeaways that you have found that were really successful, or instances that you could point to that were real value adds in getting everyone aligned and on the same page?
Sure. Well, I think that one thing where the 990s and corporate governance really come together are with respect to the need to understand the corporate relationships for your board of directors, for your officers, because the 990s require you to disclose a lot about that, any transactions with those folks on Schedule L. And so I think that it gave us an opportunity to kind of hone our processes for identifying directors or trustees business relationships, even business relationships with each other, which is a specific item on the 990s. That involves like asking the right questions on your conflict of interest disclosures. I'll just to give an example. The conflict, a lot of conflict of interest disclosures will say something broad like, do you have an ownership interest in a company that does business with XYZ health system? And if somebody answers yes, unfortunately, that doesn't give you enough information to know whether to report it, because the Schedule L is written that if it's an ownership interest of 30%, I believe, or more. And so if you actually have to get down in the weeds enough to know what the percent of the ownership interest is, because if you don't have that information, you just don't have enough to answer the question. And so I think you can really kind of hone the way you're asking the questions and sort of the instructions you're giving to trustees, to make sure that to make sure you get the right answers up front, so you don't have to ask clarifying questions after.
Yeah, and then you also have the thresholds of income. And
Hmm.
looking back to when I was in-house, I know it was something that I always struggled with because these board members are giving their time, right? And oftentimes, especially at parent entities of large not-for-profit health systems, they are very busy people with, very high-level jobs. And at the same time, you're asking these very important questions. And 15 years into my career, I am still going through the Schedule L instructions when questions come up. They're very confusing. They
Hmm.
are very nuanced. And all this is to say, to get answered correctly and to avoid a garbage in, garbage out situation, there's certainly an element of education that has to come with it. Again, keeping in mind that you don't want to take more time than is absolutely necessary of people who are generously giving it to your system and others.
Sure. Absolutely. I think that's really important. But I think more investment of time and resources up front will save you time on the back end, and obviously ensure accuracy. Because calling people after the fact and asking for clarification, it just becomes a lot more difficult process. And also another thing that I think is important is another reason that you want to have all this information up front is because when the board considers certain actions, or when the board is potentially taking up a particular item of business, you need to know about all potential conflicts of interest up front, because the IRS provides a means of, or well, I guess particularly in California, state law provides a means for kind of insulating your transactions from any allegations of improper dealing or anything like that. But there's kind of a process that you have to work through to meet those requirements. And one of the elements there is, things like that the board member that might have a conflict doesn't participate in the vote, but also that the board is aware of the conflict, that the board has considered alternative proposals, things like that. And so if you don't know about the conflict, you may not know to check those boxes. And it's difficult to go back and fix a transaction, after the fact, when you haven't gone through that process.
Yeah, and as we were talking about last week, there's a lot of physicians that are married to other physicians. Perhaps they are independent contractors or own a piece of a physician practice, or their spouse does. So there's a lot of nuanced situations aside from just the board member owns a business that is doing business with the system or a related entity to it. And to your point, I completely agree. Being proactive is a lot easier than having to unwind and correct whatever went wrong, especially when it could be something as simple as board members recusing themselves, having that documented in the minutes, and having that documented, especially if it's a very large, important agreement or contract that has to be approved by the board, having that documented there as well can certainly serve a lot of headache if the system ever gets audited, just being able to hand over those minutes and show what proactive steps that were consistent with the conflict of interest policy and consistent with the IRS's rules.
Yeah, and I would say the other thing I would kind of say is, you know, conflicts of interest are, I think, inevitable, and I don't think it's practical to, set up a board that where, or even advisable to set up a board where they're so separated from the community and so separated from the health system that they're not gonna, that you're not gonna have at least some situations where you need to, just take these steps to, protect the integrity of the, voting process, because the IRS wants you to have a community board. I mean, they want you to have a board that's made up of at least some members of the community. But they also want to, control conflicts of interest. I mean, the reality is that if you have a true community board, you're probably going to have some leaders in the community, and those leaders are going to have business interests, and they're going to have other things they're involved with. And so you just need to know everything up front so that you can navigate the process, as you go.
Yeah, and what always gave me a little bit of pause, particularly when I was in house and in charge of the process, is where are my blind spots, right? So as health systems have gotten more complicated, whether it's with joint ventures, whether it's with compensation structures that are equity or carried interest based, or something as simple as these are oftentimes large boards, or there's turnover at the officer ranks, and for former officers or directors or key employees, how do we continue to monitor and be aware of those dealings with the former folks that are no longer filling out the questionnaires or are no longer going through whatever processes your system has in place to keep track of these conflicts of interest?
Yeah, I think with the formers, it can be particularly challenging. I think for the most part, if I remember from Schedule L and Part 7, with the formers, it's typically going to be direct compensation to them a lot of times that's going to then trigger them being on Part 7, which will then trigger them being on Schedule L. And so it's a little bit easier to identify those transactions. I think where, and we'll probably talk about this a little bit more, but I think where with formers in particular, it can be particularly fraught is if you don't have strong FMV support for your transactions, which can give rise to potentially like an accusation of an excess benefit transaction. In which case the scope of the folks that can be the scope of the individuals that can be kind of brought in on that as opposed to Schedule L is a lot broader. So I think we'll probably talk more about excess benefit a little later, but yeah.
Yeah, and it's a fair point, especially when that's something that's so integral to creating the rebuttable presumption that what the system was doing was done correctly and was validated on the front end. When we spoke last week, something else that you said that I really liked was sometimes you just don't know, right? Like what may wind up being a bad deal on the back end, that's kind of your insurance policy in some ways to show why this was made with, reasonable and prudent business mind going into it, and how all of this was established, how you looked at multiple vendors, and how you established the fair market valuation in terms, and the negotiation at arm's length, and the approvals, and who was involved at your system, and so on and so forth. So, I think it's a wide-ranging exposure point. And, as systems have grown more and more, it's something that's more and more challenging to keep track of when, you are running a community hospital, to your point, and people know one another in the community. It's a lot easier to keep track of who owns what business and things along those lines now, where you have, systems operating in multiple states, and, although the last year has been a little quieter, but have been acquisitive over the last decade plus, systems are a lot larger and more complex and integrated than they used to be.
Yeah, I mean, I think like, you know, maybe a traditional arrangement. I mean, it's easy to see how you get an FMV in it and determine FMV for something like, okay, a real estate transaction. You get an appraisal and then you've got the appraisal, you know? But I think now health systems are doing a lot more sort of risk-based arrangements where it might be some sort of capitation, where there's a sub-capitation thing or something. And with risk comes, you know, the chance for making more money, but also losing more money. And I think that having documentation up front to establish why this deal made sense at the time, and you know, hopefully an outside evaluator that agreed that the deal made sense at the time will provide a lot of the cover I think that you need, regardless of what happens down the line.
Yeah. Shifting focus a bit. So we've been talking about Schedule L.
Mhm.
Let's move over to Schedule H
Mhm.
for a bit. So Schedule H, the section that entities with hospital licenses have to fill out. They have to be compliant with 501(r) if they have one. And you know, as hard as it is at times to align legal and finance, now you're talking about a function that is certainly at the forefront of Congress and, you know, different organizations that do studies on how much charitable care an organization is giving out and analyzing that versus tax breaks. But you're also now involving, you know, perhaps it's marketing, perhaps there's a community benefit department. Perhaps you're operating in multiple states that have their own unique sets of restrictions and rules. Perhaps it's a new entity that just joined, and the folks that joined are used to doing things their way. Um,
Yeah.
so all of this is to say, Schedule H is a tough one,
Yeah.
especially with the community benefit reporting.
Yeah, and I think it's important for folks to understand the context for Schedule H, um, and where it comes from. You know, that Schedule H, I think, comes from, I think 501(r) was added as part of the Affordable Care Act, or at least it was amended as part of the Affordable Care Act. And you know, I think what's underpinning 501(r) is just the fact that people view nonprofit health systems and hospitals kind of differently than they view other nonprofit entities. There is more scrutiny because, you know, unlike you know, a charity or another, you know, another organization that is mainly, you know, that is doing this sort of traditional philanthropic work. You know, a hospital is operating a business and it's doing a lot of activities that more resemble sort of a for-profit business than some other nonprofits are doing. And so, you know, 501(r) and Schedule H are really kind of forcing hospitals to provide a lot more backup and detail to support, I think, their exemption. And so there's a lot of information, like you said, with respect to community benefit reporting, charity care, financial assistance, things like that, that health systems, you know, have to provide. There's a lot of, I think a lot of health systems are including a lot of narrative in their Schedule H. I think that's probably advisable. And luckily, you probably, with your community benefit report, or with, you know, sort of the mandatory reports that you have to generate on a regular basis to sort of support your, you know, your community health needs assessment, things like that. You know, you should have a lot of the documentation already available to kind of fill that in. But it's definitely worth a lot of attention.
Yeah, absolutely. I mean, you know, it's oftentimes one of the first sections that newspapers or whomever it is will flip to as new 990s come out. And, you know, there's the IRS saying it's going to audit hospital entities once every 3 years. That doesn't mean that it's necessarily going to be a full-blown audit. They may just do a bench audit, or they may look at it behind the scenes and close it without doing anything. But you also have a lot of states that are auditing it or tying benefits to it. Oregon, I believe, has their property tax exemption, now in some way tied to community benefits. And, equally surprising, you don't often see Oregon and Florida doing the same thing. Florida, it went up for vote a couple years ago. It didn't make it through the legislative session, but it was talked about. So I think that really goes to show just the widespread importance. And of course, other states have their own sets of either reporting or contingencies. And then, of course, you go to the watchdog groups, right? And they are laser focused on these numbers. They are looking at the estimated value of tax breaks, which, in my personal experience, I feel like that's always been, I don't want to go so far as to say a fool's errand to figure out the exact amount of tax breaks that health systems are getting, but it's challenging at a minimum. So I always look at those studies with a little bit of a skeptical eye. But all of this is to say, it's really important for health systems to have good procedures in place to train their folks and to make sure that all of these numbers are being captured and reflected accurately. So I'm curious, as you've gotten involved, what your thoughts are on the process and, what's been some of those more eye-opening, procedures and just challenges that have come with it.
Yeah, I think with respect to community benefit reporting, particularly the narrative aspect of it, there's a much bigger risk, I think, in terms of the narrative of underreporting, because I think there are a lot of in-kind community benefits that are being provided by health systems that folks, the different departments, health fairs and things like that, that departments just might not even be thinking about, and that may not be necessarily showing up on the ledger. And this is one of the reasons why, it's important for legal and other departments, not just finance, to be involved in the 990 process. There could be a lot of, quite frankly, like a lot of good being done in the community that by different departments that might not be like a big system-wide initiative, that you want to make sure gets captured there, because otherwise you're really shortchanging yourself, because you're not really making the strongest case that you could for exemption, for the continued exemption of your health system, and that you're meeting that you're meeting the standards for exemption. So I think that, what's really important is to make sure that you or make sure that finance has a process whereby they are soliciting input from different departments to identify the the various charitable activities that they are undertaking, and that they understand, what it means for something to really, be a charitable activity, because there could be a lot of things that they're just not thinking of or not considering that could fall under that. And so, but there are also, in my experience, there are quite a few gray areas in terms of what different systems report. Things like, we talked a little bit about, things like a health system sort of contributions to its medical foundation and things like that. Well, do you include that in community benefit reporting? Do you not? I don't think there's uniformity there. So that's a place where, in-house counsel, and even potentially, for something important enough, outside counsel may want to have a firm opinion on that, so that you at least have support down the line for why you took whatever position you did.
I completely agree. I mean, the saying that comes to mind for me has always been it's more art than science. You could give the same set of data to different departments or different hospitals in the same system and probably get, for each one of those, a different result of what winds up getting reported on Schedule H. And that's kind of part of the way it's written, right? Is just what gets included, what doesn't. And, we mentioned before acquisitive systems. And, I think that there's certainly an education element as you onboard a new hospital, as you onboard a new system into your parent entity. And, what was done before is not what's done now. And similarly, this extends out on Schedule H reporting, right? As far as are your revenue cycle or your accounts receivable folks that come over or join your system as new employees, how are you training them to make sure that they know your financial assistance policies, what your financial assistance thresholds are for charitable care, what your excessive collection actions are, or rather what you do not do as a system. It's an ongoing process. So it's a challenge though. I mean, it's a big undertaking for systems. I'm sure it is for yours every year.
Yeah, absolutely. I think that, hopefully when it comes to financial assistance, your system, the system will have a policy in place that kind of gives you what you need on that, and hopefully they're following it to the letter because that kind of really simplifies that process. I think that, it can provide a good opportunity for some of these things where you need to identify like financial assistance or charity care, whether your system has a policy, it gives you a good opportunity, you or compliance, to just make sure that the policy's in place, it's up to date and being followed, and it accurately reflects the actual practices of the organization. So this is one of those situations where, it's not just going through this process doesn't just give you the opportunity to make sure the 990 is accurate, but also maybe to tweak some things within the system
Yeah.
that could be improved on.
Yeah, and depending on what state a system is located in, there might be state requirements that are more stringent than federal requirements. So as important as it is to remain up to date and current with the IRS, there are states that may have more stringent requirements, whether it's collections actions or what can be counted or how things are counted for charitable care. And something that came to my mind as I was going through this process all the time is in an ideal world, and it's hard to do this, right? Because everyone's really busy at their jobs and their
Mhm.
systems, is making it a more frequent than a once a year conversation. So whether it's getting all the
Mhm.
different stakeholders together on a quarterly basis, right? So maybe it's finance, legal, marketing, whoever it has
Mhm.
a role to play in your community benefits process, getting those people just to talk and figure out what are we counting, what shouldn't we count, and trying to get that uniformity across the system. And Vince, as you said, I mean, ultimately, I think the best defense, and whether it's this stuff or, macro nonprofit issues, the most important thing to me, I think, in today's day and age is having policies that are compliant with the law, that are reviewed frequently, and to make sure that everyone's rowing in the same direction, whether it is your officers and leadership, whether it's accounts payroll, revenue cycle, accounts receivable, board members, legal finance. I think that maybe quarterly is overkill, but certainly more than once a year, I think would probably help to drive better results if it's at all possible.
I think that's right. I think that's right. Making sure that everybody is sort of on the same page. I mean, I think for a system like mine that has an extremely high Medi-Cal patient population, I think that the Medi-Cal the Medicaid being, Medi-Cal being California Medicaid, that Medi-Cal shortfall will drive a lot of the community, a lot of the numbers because we just have a very large Medi-Cal shortfall. Um, but particularly for a system that might not have that might have a larger, commercial payer base, I think it's just all the more important to make sure that you're supporting your exemption as much as you possibly can by capturing every single thing that your system is doing.
I agree. And, I think, especially in today's age, where people, just take easy to digest statistics, it's very easy to cherry pick numbers
Mhm.
and drive a narrative and drive a story with those numbers. Before we got on the call, I was scrolling LinkedIn and I saw someone post something about the five largest health systems, and they were quoting gross revenue numbers
Mhm.
with a line that said "not for profit?" question mark. And first of all, it's crazy to take a gross number because,
Mhm.
as I'm sure many people listening to this call are aware, hospitals operate on very small margins. So that's number one. And, on a personal level, number two is understanding that nonprofit is the type of a corporation at the state level.
Mhm.
I don't love that term. I think tax exempt is much better. And the reason why is whether you are for profit or nonprofit, at a certain point, if your expenses are greater than your revenues coming in the door, at some point you're going to go out of business. So it sounds great that not-for-profit hospitals should in fact not make a profit, but that's just not an economic reality. If we want to have hospitals in our communities that have up-to-date equipment and qualified physicians and nurses and staffs taking care of their people and so on and so forth.
Absolutely. I think that's absolutely right. And I will note that um, another besides the gross revenue, I think another area where, you're likely to see a lot of scrutiny, whether it's deserved or not, is in with respect to, there's a lot of compensation information in these 990s. I think that particularly with executives, and that just reflects, I think, the challenge of the fact that a nonprofit still has to keep the lights on, and that means attracting and keeping talent when that talent might have other options and everything like that. And so but that is something that I think is very easy for the media to see. They can just the page is it's one page where everybody's salaries are kind of set forth. And so they're going to focus on that. But if you have I think the Schedule H, if you've really supported all the good that you're doing for the community and all the, charitable activities that you're doing and your charity care and everything, I think that's one of the rebuttals that you'll utilize, is that yes, we have some people making a good amount of money, but we also, we are also, um, definitely serving a very strong net positive in the community, notwithstanding that.
I completely agree. I mean, there are few things that could get a letter co-signed by Senators Warren and Grassley, but apparently not-for-profit healthcare compensation is one of them. And, I think what it ultimately boils down to, in my view, is there's a PR risk. And, when you strip all of this back and you take a look at it, the majority of health systems, their single most valuable asset is that piece of paper that says you are a not-for-profit tax
Mhm.
exempt corporation, right? You're a hospital, you could bring in contributions and you only have to pay tax on unrelated business income. And I think what always scared me is you have, as we've been talking about, Schedule H, Schedule J, Schedule L,
Mhm.
the 990T with UBI. And, going back to these sort of watchdog groups or whatever it may be, what always gave me pause is that PR risk. And it, especially in the day of social media, is so fast and so swift that that first story comes out and no one even cares about what the rebuttal is to it, right? And
Mhm.
by then you're already in too deep. And look, a lot of the people who are reading that and they're going to come in with their own conclusions anyways, or want the story told in a certain way. But I think what we're talking about today are with Schedule H, it's how do we build up all these wonderful facts. I used to have a boss when I was at EY, and she said, the 990 is where you brag on all the good you do, and I think that's right. But then with Schedule L, And especially with your conflict of interest policies and procedures, how do you guardrail the organization from being exposed in that negative light?
Yeah, I think that's right. I think with Schedule L in particular, it's not the end of the world. In fact, I think it's pretty understandable that you'll have some transactions, hopefully not excess benefit, but just some general transactions that you'll need to report on Schedule L. I think um, I think when it comes to Schedule L, it's maybe similar to like um, not maybe it's like similar to like not reporting a an underage drinking ticket you got when you were 16 on your moral character application or something on the BART, where it's like you're not, if you disclose it, nobody's going to care. I mean, if you disclose it, it's not going to be a big deal. But then people love to, if you accidentally leave something off and then it comes up later, I think that's where you're gonna face a lot more questions,
Yeah, no, I completely agree. And I think all this goes back to our first point is these are the reasons why it's so important to get alignment between legal and finance, and now more than ever, to make sure that your board is reviewing well, it's always has access to the 990s, but ensure that the board is giving good thoughts and their viewpoint and making sure that they're really understanding that when we put these questions out there to see if you've had any business dealings, it's not to be annoying. It's because we need to lower risk and we need to mitigate risk in what
hmm
we're doing, and ensuring that we are giving an accurate, complete return that either watchdog groups or the IRS cannot then come back and say, well, this was materially wrong or incomplete, and then you have a much bigger problem on your hands.
Right, because I think at best it'll raise questions about your processes, and at worst, someone will think that you were actually trying to hide something. So, I think just err on the side of over inclusion sometimes. I mean, if it's gray, I would say to err on the side of inclusion, and make sure you're just gathering as much information as you can so that you make sure your disclosures are accurate. One thing that I've seen too is like, physicians sometimes, whenever you ask them for their businesses, or what businesses do they have an interest in. Well, this is one of these things where the information on the ledger um, can lead to things being difficult to spot, because a lot of physicians have a sole proprietorship, or they have like a personal corporation or whatever that they that the payment that their payments go through. Well, that's something. And when you ask them if they have interest in a business, they're not thinking that's a business. They're just thinking like, that's my professional corporation. Well, then when finance is looking at the ledger, they're seeing payments to this corporation, you know?
Yeah.
Um, but maybe they're not, maybe then they're they're not capturing that for something like Schedule L or Part 7, and so I think that's another instance in which you just want to make sure that the trustees are kind of aware of exactly, here are some situations that might come up, and so that they understand exactly what's being asked.
Yeah. No, I think that's a great point. And, as we were just highlighting, all of this is to say it's a risk mitigation exercise. And, I think health systems, you kind of touched on this before, especially at the executive levels. A lot of people and, could go to work for a for-profit company and make a lot more. And in my experience and in my career, I have felt as if most people are drawn to this field because they want to be at a company that's doing very important and in fact critical work in their communities, even if it's not captured on Schedule H. Um, you know, a lot of the good is being done by these hospitals, and I think it tends to attract that kind of person.
Yeah, I
So
agree. I agree completely. And Yeah, but it's just a different thing when everyone's salaries are kind of put up there, and
Yeah.
not only just the C-suite, but um, a lot of times, a lot of sort of leadership positions, and um, other positions that may not be at the very top. Um, and a lot of, when you're talking about, like, you have to, report, highest compensated employees and things like that. Um, if you have, a physician um, that's serving in an administrative role. Obviously you can't employ physicians in California for clinical work, but you can, but they can be employed for, for serving, in an administrative role at a hospital. Again, these are folks that are going to have a lot of opportunities to make more money,
Yeah.
and but still, I think when folks look at those portions of the 990s, they just see numbers, and they're not necessarily understanding the whole landscape of the healthcare market. But it's just something that health systems have to anticipate.
Yep. It's part of the process of running the business, I
Yeah,
suppose. But
yeah,
but again, I thought this conversation, it flew by.
yeah. I
So
agree.
appreciated your article. For those again listening in, it's the Protecting the Tax Exemption Privilege Guidance on Taxes, Audits, and More for Nonprofit Hospitals. And Vince co-wrote it with Nick Kump from King and Spalding. It's really a quick read, an easy read, but a really good read. I mean, it's something that I think a lot of people would find value in, and certainly will spark a lot of conversations at systems about how can we just do that a little bit better, not do the same as last year, and just every year, bring in the right people to fine tune those 990 disclosures more and more, and just make them useful. And most importantly, make them where they're putting a true and accurate picture of all the good that your hospitals are doing in their communities, because they should be acknowledged for it.
Yeah, I agree. I agree. Well, thanks very much. This was fun. I
Thank you,
appreciate your
Vince.
time.
No, thank you. And hopefully we have the chance to do one of these again sometime soon.
Agreed. Agreed. Thank you, Michael.